Getting started in the real estate game can be tough, but in today's episode, we dive in with Ryan McKenna, who's raised hundreds of millions of dollars, is a passive investor and an active investor in commercial real estate. And we talk through some of the challenges that he's dealt with, how he's overcome some of those things, and most importantly, how he recommends others go and do the same thing. If you're an active investor, if you're a passive investor, you're going to love this episode. Ryan's a heartfelt guy, and he dives into some really, really phenomenal stuff. Let's dive into it. This is the Investor Mindset Podcast. Let's dive deep into some great stuff on what passive investors need to know if they're going to go down this path, because you started down this path as a passive investor and then you went active, which I think is amazing. And I think it's a path that a lot of people should go down if they desire to be active in this business. But when you're a passive investor and you're making great money, you're kind of new to the business, you're looking at single families, people are talking about, oh, go and buy this or manage that. Do you have time for this? What are some of the things that you recommend people educate themselves, or where do they get started to start making these decisions on, hey, I'm going to invest in that deal and I'm confident and ready to do it?
Yeah, I would say just from what I experienced personally was, it depends if you want to be active or passive. And I thought owning a couple of rentals was going to be more passive, and it just wasn't. I mean, I was the one that had to take all the phone calls. I had to step away from my full-time job to deal with things, and I didn't make as much money as I thought I was going to make. And I just felt like, it was good that I had that experience to learn from it. And there were definitely some good takeaways, but there were things I learned that I just didn't really want to deal with, or that I didn't want to, manage going forward. And so if someone truly wants to be passive, you can definitely do that. It really doesn't take up much time after you've been able to, find some good partners, do your due diligence. But once you essentially wire the funds, I mean, you are hands off. You can kind of sit back and get the monthly updates and watch the renovation plans, come to fruition. And so that's definitely a path I'd say, if someone's looking to maybe start out, I mean, you can do both, but if you're going to go into it part-time, it's hard to be a part-time active investor, because you now are assuming, 100% of the responsibility and the risk when you buy an asset. And if you don't have much experience and you're doing it, maybe it's a great way to learn. You can make good money, but you also are taking on a significant amount of risk. Whereas I think in a real estate syndication, from my perspective, you're putting your money to work, with a professional real estate group that is overseeing it, that has a great track record. They've, done well. They know the market. They have all the relationships, and they're doing this full time. I just think that there's much less risk, in my opinion, starting there, learning more about it. And I always, I've got investors that do both. And the great thing about being a passive investor is that, at some point that money's going to come back to you. And if you can't find any good active deals right now, you can go park your money in some syndications. And when that money comes back, you can decide what you want to do with it. Maybe you then, become more active, or maybe you go down a path where you invest a lot in these syndications, and then you get to walk away from your job one day and then you can be active. So I think there's not, one particular path. There's multiple ways to get there. But just in my opinion, for starting out, I mean, do your research. If you're someone that needs to have control, then, passive investing in real estate syndications is probably not for you. And if you're someone that's like, hey, I want to learn from others and be part of something, and, maybe I'm not 100% sure where I want to go. I mean, syndication is not a bad place to start and to kind of test it out and to see if you like it. And in my experience, I've seen a strategy with most of our investors. After one deal, it's like, hey, when's the next one coming? Because it becomes a foundation you can build off of, and it's real. I mean, the passive income streams, the tax benefits, and then obviously the upside, the forced appreciation that you can get in these deals. So I really like, again, with my experience, I like the passive investing better, but that's just my personal opinion.
I've seen the same thing. And this is something I've been talking a lot about with folks. And there's an idea of like, everybody has an expertise. I have this strong belief that you have a unique ability. I have a unique ability. Tom, John, and Jen all have a unique ability, something that they at their core are the best at. They were born to do, and they've developed that skill set and expertise and experience to be able to go and do it well. You don't want a surgeon coming in who just got out of a boot camp, coming in and and doing surgery on you. And you definitely don't want to be putting your money into an investment if you're that surgeon who just got out of that boot camp, right? So it's so important for people to focus on what their expertise is. And if you want to be active, man, I'm all about it. There's a lot of great ways to do it. But if you are really, really good at what you do and you find that you love it and you can find some joy in it, I'm a big believer in make as much revenue, make as much money as you can, and park it and place it with people who are experts so that you can just do your one thing. Because I think sometimes there's this problem that people have, Ryan. I'm sure you see it in the industry as well, this lack of focus. You know, you talk to somebody and they're thinking about going down this path. Oh, I'm gonna do some single family, and then I want to do some multifamily, and I'm looking at storage, and I'm looking at this, and I'm looking at that. And unless you're working with other experts that are the best at those things, you're probably going to do a pretty marginal subpar job if you're trying to do all of them at the same time, because it takes time to become an expert. So I think that's some really, really strong advice.
Thank you.
So this is where it comes down to the rubber meets the road. If you're a passive investor and you're going to go down that path, it's really important to pick the right sponsor. So when you're out there building relationships and doing this for your own passive investments, what are you looking for in a sponsor? And what's that process that somebody who might be investing 50 or 150 or $1 million into a deal might go and do?
Yeah, so I like to look at the team behind the deal. I mean, a lot of times people get caught up in just looking at the numbers, and I can tell you, the team, the people behind the numbers is what's most important. So get to know that sponsor, that operating team, look at their track record, talk to other investors who have invested with them in the past, and just really get a good comfort that they've got a good philosophy, good focus on the market that they are targeting, and that they've built a good team around, because I bet all day on a really solid operator that I feel confident in than just someone who is putting together, shiny, nice numbers that, in a glossy investor deck. I mean, I think it really comes down to, who you feel comfortable with, the relationship that you have. But again, going back to the track record, the market focus, because the market does matter too. I mean, I look at different deals. I mean, there's a reason we're focused in what I would say your tax-friendly warm weather states. I mean, there are also very landlord-friendly states. And so that's, in my opinion, looking at different investments, those factors matter. But I think it's the people that matter most. And if you can get that right, then you can start to kind of dive into the deal and look at the sub-market, look at the underwriting, how conservative is it? Just try to find any red flags you can. But at the end of the day, it's not going to be like, this feeling of like, hey, everything checked the box, 100%, I'm ready to go. I mean, sometimes, you feel 85, 90%, good about the opportunity, and you just got to make that jump and just know that, even if everything is laid out 100%, the way you want it to, it's a real estate value add deal. Things are likely going to change a little bit. There's going to be some bumps in the road. So I wouldn't get all hung up on it's got to be the perfect deal, the perfect opportunity. I think if you get, a level of comfort around, who you might be investing with, I think you got to make that decision and then back them, because, they're the ones that are responsible for executing on the business plan. And, 5-year horizon's a long time. So again, if there's a bump or two in the road early on, it doesn't mean that the deal is going to be bad. I mean, it's to be expected. So part of this is, kind of throwing yourself out there, taking some action. But after you've done your own due diligence and you have a level of comfort that, this is a good partner that you should be investing with.
Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share it with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.